welcome back to this week's market update coming to you from Kelly. Today is July 14th, Friday morning here, 2023. We're super excited to bring you another week full of updates. It was an exciting week for the bulls with lower than expected inflation data coming in, as well as a good start to the second quarter earnings season. We also saw gains for the week accordingly. The Nasdaq Composite gained 3.3%, the S&P gained 2.3%, and the Dow Jones Industrial Average gained 1.3% as of close on Thursday. On the other hand, we saw the 10-year U.S. Treasury yield slip nearly 6% here, as inflation expectations over the future dip down. Jumping right into our economic data of the week, on Monday morning, the Federal Reserve released data on May consumer credit, where we saw non-revolving credit growth slip to just 1.8% from a year ago, which was a 2-year low in terms of growth rates of these key consumer purchases, such as auto loans, mortgages, and student loans. On the other hand, we saw revolving credit, which are things like credit cards, personal lines of credit, or home equity lines of credit. They rose at a much steadier rate of 8.2% year over year in May. We're seeing those higher interest rates be more and more apparent to consumers through those big ticket items, the home, the new car, and the degree, despite the average credit card rate sitting at 2 to 4 times the interest rates on those bigger ticket items. For example, you can see here just how rates have changed on these key purchases over the last few years or so. In February of 2022, we saw the average 60-year new car note rise from 4.5% here to 7.8% in May of 2023. On the other hand, we saw the average credit card rate rise from 14.6% also in February of 2022 to 20.7% in 2023 in May here. So we're seeing a lot more demand for credit cards, those short-term, liquidity needs versus the bigger ticket items that consumers, were maybe more geared towards in a lower interest rate environment. So this is really important just to look at as we look for consumer trends and also how companies may perform based off of this data. Moving on, we also got the wholesale inventory data for the month of May. It was completely flat month over month at 913.7 billion, but it continued the upward trend that we've been in ever since the end of 2021. I think a lot of this is due to the supply chains getting built up over COVID, over the pandemic, and all of those issues that ultimately led to the higher inflation. But now that we have higher inventory levels, this supports the case for lower inflation on the horizon as supply is building up and demand is generally flat. On a similar note, we also got the June CPI and the PPI numbers for inflation during the month of June. They both came in lighter than expected, with the June CPI coming in at 3% flat on the headline and a core CPI of 4.8% on the headline. On a monthly basis, this amounted to a CPI and a core CPI of 0.2% growth month over month. Leading inflation higher from May to June was energy, which was up 0.6% month over month, as well as food at home, up 0.4%, and shelter, which was also up 0.4% month over month. Lower prices across used vehicles, which were down 0.5% month over month, as well as utility gas service down 1.7% month over month, and fuel oil, which was down just 0.4% month over month, which led the CPI lower. The really important thing here is that food at home had only stayed flat in the month of June, as it has really not increased too severely over the months prior to that. Actually, it's fallen on a month over month basis, which is a good sign for consumers' necessities and their cost stabilizing. Other food staples, including meat, poultry, fish, and eggs, actually fell 0.4% in the month of June, month over month, which is another good sign of disinflation and maybe even deflation in certain products. I think overall, the CPI print marked a really important downtick as the Fed aims to hit their 2% target. Continuing our inflation data of the week, we also got the producer price index this week for the month of June, and it was similarly lighter than expected, just like the CPI print. Annual headline PPI posted at a 0.1% rate year over year, while core PPI posted at 2.6% year over year. On a monthly basis, both headline and core PPI came in at 0.1% in June. Similar categories between the CPI and the PPI drove the data higher on a month-over-month basis. So we saw energy lead the higher inflation in PPI, while other costs such as lower food cost actually decreasing deflationary month-over-month, and lower transportation and warehousing costs drove the PPI lower. We're really encouraged that this PPI, which is typically a leading indicator of the CPI and consumer inflationary pressures, is continuing to move down and even really close to 0%, as the core PPI is near 2%. So we're really encouraged by this, and we hope to see the CPI and PCE come in lower over the coming months. In other news this week, we had Q2 earnings season begin with some of the largest banks in the world, JP Morgan, Wells Fargo, as well as Citigroup, all report their earnings on Friday morning. All three beat their earnings estimates, while JP Morgan and Wells Fargo raised their forward guidance and had the most bullish earnings and revenue reports. On the other hand, Citigroup did beat EPS estimates, but in other ways, such as their investment banking business being down 24% year over year, suffered quite significantly. So we'll continue to watch earnings season for all of our holdings and all other companies that are on our horizon to best manage each of our portfolios. A final update of the week, we got the University of Michigan's preliminary July Consumer Sentiment Index. It surprised economists to the upside this week, coming in 41% higher than it was last year, and it is the highest level since September of 2021 at 72.8 here. The lower inflation and the higher wage gains definitely have been contributing to this, as consumers feel slightly better off than they were a year ago, with super high inflation hitting the grocery stores and pretty much everything else that consumers were buying. I think US consumers are really starting to feel more confident in the economy, which is really interesting given that many leading indicators are forecasting a recession. Overall, though, this is just really important data to look at as we continue to monitor the markets. Thank you so much for tuning in this week, and we look forward to providing another update next week.